On December 4th, 2024, shares of the trade desk hit their all-time high over $139 a share. As I'm recording this video, the stock is less than $51 a share. In other words, it's fallen by basically two-thirds in less than a year. Now, I'm pretty bullish on the business, and you can count me among the people that thinks that the trade desk is a great business. Even when the stock was falling, I continued to view it as a high quality business, but the stock had become priced for absolute perfection. All it took was a stumble along the way for it to lose its luster in the eye of investors who had gotten so used to seeing the company beat its own guidance and then raise that guidance on a regular basis. Here's the question though, being able to buy the stock for less than $51 a share, is this an opportunity to buy a stock that can help me become wealthy? I'm Jason Hall. This is Investing Unscripted. We're going to take a closer look at the trade desk today and whether I think it's a stock that should go in a portfolio for people that are trying to build wealth. We're going to take a closer look. Before we do that, this video is sponsored by the Motley Fool. We get to make our videos because of that partnership. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Go to that link, sign up, and you can get access to the Motley Fool's 10 best stocks to buy right now. Not just right now, but members get access every month to the Motley Fool's most timely best stock ideas. Go check that out. Okay, let's take a look at the company's most recent earnings presentation just for a little bit of background. The first thing that you can see in the blue chart here on the right, this is the revenue growth rate. This is now basically a $2.5 billion annual business, and it's still growing at a fast rate. But we have seen the revenue growth rate has continued to slow. And that's should be to some extent expected because that's what happens with growth companies. As the revenue gets larger, they consume more and more of the addressable market, and the growth rate does slow. But it certainly slowed faster at the trade desk than a lot of investors were expecting that it would. But at the same time, it's a massive and growing market. And I think that's part of what has concerned. The market is $1 trillion market and continuing to get bigger. And this is the market that the trade desk is looking to serve. It's the platform for ad buyers, whether you're a brand, an ad agency, a technology company that's in the ad business. You're looking to find ads that are going to help you and your clients get the best return. The trade desk's AI powered platforms are built to do exactly that. I'm going to hop out of the screen share and just lay some background here. Something that's been going on over the past year. The trade desk has been working hard to transition clients from its legacy platform to Kokai, which is a newer platform, more AI integration that it says is better and is going to be more powerful. And if we go back closer to the beginning of the year, when the stock really first started to fall, companies missed its own expectations and management actually lowered guidance. Founder and CEO Jeff Green said, look, we haven't done the things that we need to do as well as we need to do to make sure we capture as much of this opportunity and accelerate the transition of our customers over to Kokai. Since then, the company made some progress. And then in its most recent quarter, again, hit some stumbling blocks. Now, at the same time that that's happening, lots of other companies are looking to take advantage of the opportunity. It's a roughly $1 trillion opportunity. A market that big, you're going to have lots of players. You have companies with the walled gardens like the Amazons, the Alphabets, Meta, all of those companies that have ad inventory on their own sites, those walled gardens. They are looking to maximize their own inventory. A lot of them are starting to create deals and starting to build tools that to some extent might be competing with the trade desk. The sell side and the buy side, the lines are starting to blur a little bit. We're seeing more consolidation. That's meaning more competition for the trade desk. The company's also made some pretty significant moves in its executive ranks. If we go back to this spring, the company hired an experienced executive from Salesforce to take its role as chief operating officer. That was a big move, taking some responsibilities away from Jeff Green and other executives, and I think a necessary step to help the company be positioned as it continues to scale up. More recently, over the summer, the company replaced its CFO, and this is a big transition for a business. Over the long term, having these two key executives in place is going to be good for the business. But again, there's a period of adjustment for a management team with two new voices in the room, bringing in their experiences, their expertise, and it's going to take time for that to play out. And then most recently, the company announced a pretty substantial overhaul for Audience Unlimited, which is an upgrade to the marketplace for third-party data within digital advertising. And in short, the idea is to try to optimize, increase precision, and create more openness when it comes to ad auctions. So this is something that they're working on. There's been pushback there. Jeff Green is really leaning into this and says that in the long run, it's going to be healthier. And the ad sellers aren't necessarily maximizing and optimizing the value of their ad inventory. So it's an interesting position for Jeff Green to take, considering that his customers are the ad buyers. But at any rate, he sees an opportunity for more openness and a better, more competitive ad market. So that's a healthy thing that's going on. That's also kind of rattling the cages of the industry a little bit. But you put it all together, and I think the business is in pretty good shape. Now let's talk about whether or not the stock makes sense. And this is a stock that can help create wealth for investors. We talked about that $51 a share price you can buy the business for at recent prices, but we really have to look at the fundamentals to find out if this makes sense and think about the opportunity. So the trade desk right now is about a $25 billion market cap business. Again, down well more than half from the 60 billion plus market cap for investors who bought the shares late last year. Now, what does that represent? If we go to the company's timeline that they provide, one thing that you can see is that in 2024, the company's adjusted earnings were about $832 million, and its adjusted EBITDA was about $1 billion. These are adjusted metrics. They're not perfect, but directionally they can be useful. So if we use that $1 billion in adjusted EBITDA and we look at it against that, call it $25 billion, you're paying basically 25 times adjusted EBITDA for the trade desk right now. Now, is that expensive? Is it cheap? I think it's a reasonable price considering the company's growth trajectory is still there. This is not a no growth business anymore. It's still growing revenue at well over 20% a year on an annualized basis. 25 times adjusted EBITDA is a reasonable price to pay. But really what it's going to boil down to is execution and continuing to defend its moats, growing its share of the total spend in this growing bucket of programmatic advertising. I think the company is going to be able to do that. I'm a bull. I believe Jeff Green knows what the company needs to do. They have the best product. They continue to innovate, and they're integrating AI in ways that are helping their customers get better return on their advertising spend. I think that value proposition is still real. Yes, there's more competition, but I think competition is healthy because it forces companies to continue to innovate and go fight for their share of the market and grow it, and not just sit back and expect that everybody's going to continue to do business with them. Put it all together, and I think the price, that less than $51 a share, is reasonable. This is not a deep value stock by any means, as much as the stock has come down. There's a little bit of a turnaround play, but it's really an execution play. If the business continues to execute over the next 3 to 5 to 10 years, I think investors that pay today's stock price are going to beat the market, and they're going to be super happy with the price they paid. And it can be a stock to help create wealth in those investors' portfolios, mine included.